Hey, what's happening? It's Trader Tim from EminiMind doing a Monday market analysis video. Lots of stuff to talk about, everything from the daily chart down to intraday time frame stuff. So let's just dive right in. The ES on the daily chart still making those new all-time highs. If we go out to the weekly, you can see taking out the prior major swing high these last couple of weeks. And the thing I want to point out is as we're kind of grinding higher along this 21 EMA here, when we make these pullbacks to whether it's the EMA or a trend line, we want to look for the swing highs and swing lows. And for those who've been watching videos for a long time, this is one of the first times you've probably seen the this moving average on my chart. I added it about a couple of weeks ago, and I was just tinkering with it a little bit. So I'm not sure if I'm going to keep it, but from a general trend line perspective, we can come in here and draw some basic trend lines connecting the swing lows and the swing highs. But I just felt like the 21 here did a decent job as well of kind of picking up some of those swing lows. So as we zoom into kind of the most recent couple of weeks, we can see when we get these pullbacks, those lows are very key levels. And the concept of swing high and swing low is something that you'll use whether you're trading daily bars, whether you're swing trading, whether you're intraday day trading. That's kind of the core, the fundamentals of the market structure. Identifying whether we're in an uptrend, a downtrend, or sideways no trend, all comes down to where are we in relation to the last swing high, the last swing low. And so when we make these pullbacks and then we rally and then we make a new high, we end up with another swing low. And there's really two layers, if you will, to solidifying a swing low. So the first thing that can happen is, so we'll just use this pullback here. The market is going, we'll ignore I believe that was MLK day. The market makes a lower low than the prior candle. So you got this red candle on the 12th. Next full market open day, that'd be Tuesday the 16th. That goes below the prior candle. So we're starting to pull back. We're moving down. Next candle, we gap down and break the prior candle's low. Well, when we break that low candle, the high price of the low candle, or the high of the low bar, HLB, high of low bar, high price of the lowest bar in the pullback, now we start to signal the trend change, and this becomes kind of the secondary or the little bit less impactful swing low. The super strong swing low is formed when we break highs. So when we break above this prior high over here on this big green candle, now we really solidify this little hammer down here as a swing low. When we take out that candle's high, technically it does become a swing low, but there are instances where we'll make a small bounce. We won't break highs. We'll make a small bounce. We'll pull back, sometimes known as like a two-leg pullback, where you bounce, you pull back, and then you make the break into new highs. And so that's why I say just breaking the high to low bar, that's kind of the early sign of the momentum change. That's what I use for my entry signals on daily charts or intraday time frames with a stop below the low. But when we get moving and we break into new highs, that's when that really solidifies that as a swing low. So both of those can be used for managing positions, trailing your stop. Intraday, it's kind of nice to be a little bit more aggressive at times because you're catching a swing to the upside that might be 10, 15, 20 minutes, and then the market changes direction, then you get a small downtrend for 20, 30 minutes. And so I'm less interested in leaving my stop super far away intraday because there's more opportunities that are coming over and over again. Whereas on the daily chart, I can be a little bit more patient at times and let the market pull back and then let the give it some time to work its way into new highs as opposed to getting in and getting out as quickly. So that's swing highs and lows in the daily chart. A couple other things. Let's see, before we go intraday, I bought some puts on the inverted hammer. I ended up closing them out on the very next day because we closed as a hammer. We came down to the 21 moving average. I sold a few at the open, and then I dumped the rest at the close because that was a pretty bullish bar off of support and off of another 50% here. So there, if we go back to the last swing low, that was down here. And then all of these bars made a higher low, higher low, higher low. Every single low of that next day made a higher low. And so same with down here. We had this little hammer and higher low, all the way up. So you get 1 day pullback, and then it was straight back to that uptrend. So we had a monster gap down relative to the current volatility and range. And then seeing it as a kind of a bullish hammer candle, that turned me off to hanging on to the puts. Had we closed a big bearish candle like this guy here and been a little bit off the moving average, or the basic trend line, if we had connected these lows, I'd be okay hanging on to them for another day to see what happens. But that's how I manage the put there. The other pattern that comes up a lot are bullish and bearish engulfing patterns. So this is what I would consider. So an engulfing pattern is, there's a couple different ways to interpret it, but the simplest way is the high and the low of that day are above and below the prior day's high and low. So as opposed to an inside day where the entire candle, so like this green candle on the 8th, its high and low is inside or within the prior day's high and low, those days tend to be a lot more tight range and more choppy. So you got like a dragonfly candle here where the open and close are about the same. Same with back here. Both of those are inside days, very small, tighter ranges and less volatility. Here with a engulfing candle, this one is a bearish engulfing candle because its high and low are above the prior candle's high and low, and it's up at highs. Whereas if it was a bullish engulfing candle, let me scroll back, see if I can find one quick. And more like something like this, where this is the 6th of October, its high and low is above and below the last couple of days candles. Now some people look at it as in the body versus the tail and the wick. I'd ignore all that stuff and just look at the full candle itself, so the high and low. And that's kind of a another kind of reversal signal. You can see this bearish engulfing candle here is just below the prior highs. So if we roll over from here, now we're solidifying this as a swing high. If we break this swing low down here, then it really solidifies it basically in concrete that this is a lower high as it relates to the inverted hammer high from just a few days before on the 12th. So those patterns are really helpful, whether it's a daily chart, intraday chart. And then the other thing I wanted to touch on with swing trading, and especially with the daily bars swing trading and managing trades, is if you are here, I'll do this, create new set that way. So if you're on Thinkorswim and you have different drawing sets, then you can keep your drawings on one drawing set and then move to a different one and have a completely clean chart. So with Bitcoin, I did buy more at the 40,000 level. It's not a perfect hammer, but you see this red bar in the 23rd. I consider that close enough. And then we've got each consecutive day or following day made a higher low. Rather than come in and aggressively trail each candle, the concept of trailing the swings, so the swing highs and lows, what we were just talking about, waiting for the pullback to occur, and then either one of two ways. once it breaks the high of the low bar, move your stop from below the entry point candle, or the entry candle's low, up underneath the swing low, or waiting for a break of the high before moving your stop. Either two of those methods are fine. And then when we start getting, this is a fairly newer concept that I guess I've quantified. I've done this on the daily chart when I swing trade before, but I didn't really have a way of quantifying it. So what I'm talking about is when we start to lift off, or go straight up. So here again, this 21 moving average. In the past, you've seen me just draw, a basic trend line. Here, it's a nice 45-degree angle. Then all of a sudden, you're going up, 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 straight up. You're getting really far away from that trend line. The distance here, you've got a big gap. And so sometimes, in order to fill that gap and make our way back to the trend line, we just kind of drift sideways to it. Other times, we get a sharper pullback to the trend line. But the idea is when we get going up, 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 straight up, away from the trend line, rather than having my stop be all the way down here, I want to come in and start tightening my stop. And so the way I've quantified it is if we get 4 bars, in this case if I'm long, 4 green bars in a row where each candle makes a new high, new high, new high, new high, then I'll come in and start trailing my stop behind that 4th bar and in every following bar. And so this is something that's been working really well intraday, and it's something I did on the daily charts. I just didn't really quantify it to 4 days or 4 bars. It was more of, okay, well, I'm trailing swings, and then, wow, things are really starting to take off. Or if I was short, sell off really hard. Let me come in and start trailing each candle. Using 4 candles is just kind of a way to simplify it a little bit or quantify it. So at the moment, you can have your stop if you're using the BTC, the futures contract. You could have your stop up here on the actual Bitcoin token. If you go into the kind of the equivalent daily chart where you're going to have Saturday and Sunday, you'll see a little blip below the prior candle's high. But either one of those, whether you're trailing on the futures market and you got to just wait for the wait through the weekend to take your position off or to manage the position, or if you have like a Coinbase account or something where you're swinging the cryptocurrencies, that's a great way to manage it. And then you can capitalize like from 40 up to 50. Let's say we break here below this inverted hammer. Let's just say 40,000 to 50,000. Take your profit, and then on the next pullback you can look for another hammer to get in. Maybe when we come down towards this trend line, re-enter, let's say at 48, and then swing it up to 58. So that's a really good way to kind of be more active with swing trades, but still being diligent with your stop, so that you're not just it's not just like a speculative thing. Oh, I'm going to buy Tesla and then look at it in a couple months. So it's a little bit more active trading. And then the last thing, let's see here. The last thing, we can come down. I guess we'll just go down to the 1-minute chart. And so like the same concept of buying on the pullbacks, whether you're using some kind of moving average or just a trend line. Like I said, I'm not sure if I'll keep this 21 EMA on the chart. We were just chatting with a trader about it, and we'd put it up for our conversation. And I said, oh, well, I'll leave it up there for a couple of weeks and see if it's helpful, or if I end up making any observations off of it. But if you find these hammers on the pullbacks, whether it's at a trend line, like I was saying, at a 50% retracement, pullback, or kind of in that area, and then buying above the high of the low bar when it's a hammer, and then stop below the low, and then trailing the pullbacks as you move higher. If you do start to take off, I don't know if this one really did here, but if you were to kind of really take off and get those 4 green bars in a row where you're really getting lift off and going straight up, then you can come in and trail your stop a little bit tighter. But at the start of the trade, it's really important to give yourself some room, especially if you're trading the ES, and not tighten too quickly. If you get a 1 point move or even a 2 point move in your favor, and you immediately move your stop to break even, yeah, you're not going to have as many like your winning percentage will go up because you won't have a losing trade, but your average winner is going to come way down because you're going to have all these scratch trades in there, and then some of the trades will end up taking off and you won't be in them. So if you can be patient at the start of your trade, and then once it gets away from your entry, then start trailing your stop and being a little more aggressive if it really starts to rip. That way doing that will help keep you in trades a lot longer, the winning trades a lot longer, and not just get you taken out early on. So a little shorter week this week. Market holiday today with President's Day, and so Tuesday, Wednesday, Thursday, Friday we'll be trading. Tomorrow morning we'll be doing the live trading session. You can check that out. There's a link below, EminiMind.com/VIP. And if you like these videos and you feel like I deserve it, go ahead and give me a thumbs up. Appreciate that. Hope you have a great week. We'll talk to you soon.